Welcome to the Berkridge Group, how it works, how our strategies work, part 2. And we're going to go over a few case studies and get more specific into what some of the applications for these plans are. So one is the 1035 exchange study. So this is when we have a client that has an existing life insurance policy with cash value. And we review the client's existing portfolio, and this is a way to maximize the efficiency and effectiveness of these values. We should go through, if we have existing clients, we're an advisor, we have existing clients, we should audit our book of business, see who qualifies for these programs. Again, a net worth of $1 million or greater. And in the 1035 exchange scenario, who has life insurance with cash value existing? Send over all the information, trial app, policy value summary, and we will assess the 1035 exchange values. Most of the time there's no collateral required. We can move them into a new product with new benefits and apply some financing that will reduce or eliminate the client's out-of-pocket expenses. This is good for individuals of all age. Disregard the $5 million net worth. September of 2015, that was dropped down to $1 million. And big benefit here is to supercharge the accumulation potential and the policy death benefits. And here's what it looks like. A client age 51, say he has $311,000. This is an actual case we worked on. And a client has $311,000 of cash value in existing life insurance policy. We're going to obtain $5 million new death benefit. So new life insurance policy here, $5 million. You'll notice this increasing over time and then decreasing and coming back up. I'll show you why. We're going to fund $235,000 a year for 7 years. Client in this scenario is paying $36,000 a year. That's what he was paying before. Now, in any year, he can defer a payment. He could pay more. He could pay less, whatever it is. If he runs this through his business, then he could deduct the interest. In 10 years, there's enough cash inside the policy to repay the outstanding loan. You'll notice our loan balance goes to 0 right here. This 1.7. Follow the ledger here in yellow. The $1.7 million comes from the cash surrender value of the life insurance policy itself. You see it drop from $2.4 million to $800,000. So that drops down there. Then here we're showing distributions. So the client is actually borrowing from his own policy, tax-free. Okay, this is really when it becomes a great tax strategy, or one of the applications of it. He's borrowing from this tax-free over $100,000 a year, and this is indexed for inflation, so this is going to increase every single year for the rest of his life, well through maturity. So this is a great way to take this old $300,000 he has sitting in the old policy, repurpose it, rebirth it, put it in a new policy, increase the death benefit, and maximize the tax-efficient distributions of it as well. So this is a win-win for the client here. So this is a great way to repurpose that cash. And one of the things to look out for when we're looking for opportunities, looking for clients that can benefit from this planning. Here's another one. This is a business planning study. So this is when we have business owners, they're in partnership together. It doesn't matter what industry they're in. We've been dealerships, gas stations, construction companies, professional services, attorneys, dentists, doctors. What are some other ones? We've done a lot of these particular applications. They're great to work with because there is a very specific need, specific and it's business related. So here's an example of one we actually did. Obviously the names are different, but it was an auto dealership. We had two 50-50 owners. They're both 40 years old, and they are buying the insurance as part of their buy-sell agreement. If one of their partners, to fund it rather, if the partner passes away, what's the other partner to do? So it buys their shares out. And another thing is, what if he becomes ill? What if he becomes disabled? Is there a way we can try to buy out his shares in the business with this type of planning, and there is, because we use a insurance policy, the underlying asset we're using to fund this buy sale. We use one that has a long-term care or living benefits. We can accelerate the death benefit to go ahead and protect the other partner if one gets sick. So they're each gonna buy $2 million of insurance, and the insurance includes those benefits I just described: acceleration or death benefit for critical illness, chronic illness, and terminal illness. And we're using, this is when it's good to have tax attorneys on your team. This is and as one of the Berkridge Group advisors, you have 24/7 access to that. You have access to the tax attorneys. You have access to the CPA. You have access to, that have done many of these transactions, so we see it from all different angles, what to avoid and what to take advantage of here. But this is where we're using the partnership exception to avoid the transfer for value rules and structure a smooth transition of business ownership and to protect against disability or illness. So that's the backstory. Here's how it works. Our buy-sell agreement funding. This is one of our financing arms here. So we have the business, buy-sell plan, buy-sell option agreement, owner 1, owner 2, affects policy on his or her life, so 2 policies. Comes down here, the deceased, disabled owner's family, 1 or 2, the policy proceeds go down there tax-free. Okay. And here's the structure. So when we're looking at this, we use typically a comparison. So we use term insurance to compare the cost benefits. Now, if these individuals were going to buy this term policy, okay, it would cost them $24,000 for 20 years. Let's imagine we're buying $5 million a term now. Cumulative cost of $484,000. There's 0 cash value in the 20th year, 0 death benefit. Unless they renew it, it's going to become very expensive and the costs are going to increase every year, and 0 living benefits. Now, if we were using a finance permanent policy, let's assume the client's going to contribute $24,000 for 14 years in interest payments. Cumulative cost of $336,000. So this is a financed option here. The cash value, look at this cash value. In the 20th year, $1.4 million. And I'll show you exactly where this is coming from in the next slide. Death benefit in the 20th year, it's still there. Okay, the term didn't expire because this is permanent coverage. This is where we're winning against if you want to break it down really simply, you want to win against the insurance company or do you want to lose against the insurance company? This is what everybody does. This is what smart people do. This is what only 600 transactions a year are doing, and that number should be much, much higher. $5 million plus in death benefit and living benefits, even accessible in the second year. If something were to happen, we could accelerate $1.5 million of the death benefit. They become terminally ill. That means we have partner A and partner B. Partner B becomes sick, becomes terminally ill. What's partner A going to do? He's stuck with that. The wife's going to help out, or just accelerate the death benefit, start buying out his shares. You could trigger chronic illness. He becomes chronically ill. That pays out $30,000 a month. Or critically ill, $1 million up front. Accelerated the death benefit, not even coming from the cash value. Only a few products have these benefits, and we can finance all of these benefits. So long-term care, terminal, chronic, and disability benefits. Call our office. We can send you information on these and really what triggers these benefits, because this becomes a business sale with a variety of solutions. Right? We're solving for all these as well. We have many different trusts that we put these in. It really depends on, and it really does depend on the overall structure of the plan. But might need to zoom in on this and make sure you get a really good look at what's going on here. So similar to the other structures, we're funding 7 premium payments. This is a $5 million policy for the 40-year-old, $237,000 a year for 7 years. Client's contributing this amount of interest, $24,000 a year for 14 years. Now this is going through their business, so they're deducting this. So it's actually costing them, depending on their tax bracket, more like 14 or so thousand dollars. Now, flexibility. In any year, they could pay interest or they can defer it. We always price that in there. They have a bad year here. In the second year, they don't need to pay the interest. They can elect to defer it. That's fine. We're doing a floating rate pegged to 1-year LIBOR plus a cap. We already stress test our rate to increase as we move along the yield curve. So move along the yield curve here. In the 13th and 14th year in yellow, you'll notice we're chopping away at this ending loan balance. We're going to start repaying the loans. There's so much cash built up here. We don't need to. It's just an option. Some of the clients want to repay it as soon as possible. Some don't mind it. Staying on there. So, and we're not going to complain about it because we're still getting our interest on this cash secured loan. So it's a win-win for all of us here, except perhaps the insurance carrier because they're going to have to pay out this death claim. 13th year we take some money out. 14th year we take another $1 million out. Notice the surrender value decrease all the way down here to $700,000. Over time, this continues to increase. We still have over $5 million of death benefit. At age 65, we have $2.28 million of cash value, over $6 million of death benefit in here. And key points, flexible payments, living benefits, high accumulation value, asset protection. And look at this, $150,000 a year index for inflation, tax-free. Client can take that out tax-free from the plan. So this is one of those, it started out as a business planning strategy, and this is something they can also use for personal reasons. And a normal 40-year-old client can do this as well with no business involved. This is another option. These are the living benefits here. This is straight from the insurance portion of it. Total premium, guaranteed death benefit, net death benefit, terminal, chronic, and critical illness. There they are. So collateral options, go back to this plan here. You'll notice there's a little bit of collateral needed. That's the client's skin in the game. Really, that's to cover the surrender charges that are imposed by the insurance company because they don't want these policies to be surrendered in the earlier years. There we're looking at letter of credit, marketable securities, cash equivalents, whatever it is, only about $90,000. And we can help structure that and help get around all the collateral questions. Cash equivalent, non-qualified annuities, commercial real estate, letter of credit, and this is our financing arm. ACA secures collateral, so we help with all of that as well. Who can benefit? Existing book of business, pocket case is the best ones to have. Annuity clients, business owners, how are they funding their buy-sell term policies? You can imagine this is the easiest one. Converting a term policy to a permanent one and financing it. That is very, very easy for us to turn around. We can refinance outstanding policy loans at a more favorable rate as well, and we can also take existing permanent policies, increase the face amounts, and finance future premiums of those two. So the process, together through this video, through our in-person meetings, we're going to help you identify opportunities. We take that, fill out a trial application with all the facts of the client. Get the trial app from the materials section of this same website. Go to our strategy sheets. That's presentation material showing everything, really a lot of what we just covered here. That's our client, and then client presentation. We go with you, help present to the client. The client has attorneys, CPAs, etc. That's great. So do we, and we let our attorneys and CPAs talk to theirs. Checklist, finance and insurance application, all the required information is on that checklist. You'll also see at the website. We start obtaining the approvals, we get the insurance underwritten, we process all the paperwork, we process your contracting paperwork, and we get the financing all approved. If there's outside collateral required, we get the collateral perfected, and we get the policy funded. And we do the design, implementation, and annual review. We also have a trust company we work with that helps administer all these, and we really do facilitate the process from start to finish.